Hello everyone, and welcome to a brand new video on the channel. Today we are going to talk about the top 10 steps to create a winning investment portfolio. Before we get started with the video, don't forget to smash the like button, share the video, and subscribe to the channel. Now let's get started. Number 10. Consider costs and commissions. Investment fees are frequently neglected when constructing a portfolio. However, these can have a significant impact on your long-term success or failure. Commissions and annual fees paid to stockbrokers or counselors, expense ratios for mutual funds and ETFs, surrender charges on annuities. All of these should be considered when designing an ideal portfolio because they can have a significant impact on your long-term returns. It's crucial to remember that expenses diminish your investment returns, so keeping them minimal pays well. Mutual fund investors can benefit from the numerous no-load funds available, while stock buyers should compare commissions among brokers. There are also exchanges that charge as little as 0.25% for trading crypto assets such as Bitcoin and Ethereum. Number 9. Set your investment goals. The first stage is to identify and emphasize your specific financial objectives. Ask yourself, how much money do I need for my retirement? Or what kind of returns do I expect from my investments? Do you intend to invest for a specific goal, such as purchasing a home in 10 years? Or do you simply want a steady stream of passive income? Knowing your objectives will help you select what investments to make and how much risk you are willing to take. Consider your investment horizon as well. An investment horizon is the amount of time you plan to keep a certain asset or group of assets. To achieve your financial objectives, your investment portfolio should be made up of several assets with differing maturities. Number 8. Monitor, rebalance, and adjust. After you click Buy, your investment portfolio still requires constant care and attention. That is why it is critical to continually review and alter your portfolio. For example, you could review your portfolio twice a year to ensure that your asset allocation is still in line with your objectives. If the market has been turbulent, you may need to rebalance your assets. If you invest with a robo-advisor, many will handle rebalancing for you. You may also need to revise your investment strategy when your circumstances change. Marriage or divorce, becoming a parent, receiving an inheritance, or approaching retirement are all life events that may require you to reconsider your existing financial strategy. The best investment portfolios develop and thrive in the same manner that home plants do, with constant care, attention, and feeding along the way. Number 7. Create your asset allocation and diversify. After you've decided on the types of investments you want in your portfolio, you must decide how much of each you should purchase. While you may be tempted to invest every penny you have in stocks in order to maximize returns, Robinson recommends that his clients think differently. Making money is great, he continues, but how much did you not lose on the way down? Asset allocation prevents you from placing all of your eggs in one basket and instead assists you in dividing your money in such a way that you can experience capital appreciation while limiting losses. For example, if you have a high risk tolerance and a 30-year time horizon, you might allocate 90% of your portfolio to stocks and 10% to bonds. A portfolio of 60% stocks and 40% bonds might be appropriate for someone with a moderate risk tolerance. You can diversify your investments within asset classes once you've decided on your asset allocation. For example, you may allocate 90% of your portfolio to large and mid-cap companies, and then diversify your holdings across several sectors, such as healthcare, industrials, and technology. Number 6. Understand your risk tolerance. Now that you've determined when you'll need the money for each objective, you can determine your risk tolerance. How much money you're prepared to lose in the short term to reach each goal. The longer your time horizon, the more aggressive you can be, says Dennis Poljak, a CFP at Poljak Group Wealth Management, because you have more time to recover from short-term losses. Short-term goals, he says, necessitate a more cautious technique since you can't afford to lose what you've accumulated. Risk tolerance and temporal horizon go hand in hand. For example, if you take on too little risk when saving for retirement 30 years in the future, you may fall short of your savings target. However, if you're 5 years away from retirement, taking on too much risk could mean losing money with no way to recover. Your risk tolerance is ultimately a balance between what is required to achieve your goals and how comfortable you are with market volatility. Number 5. Identifying investment styles and strategies. It is critical to discover the investment styles and techniques that best correspond with your financial goals and risk tolerance when you begin your investing journey. Value investors look for companies with good fundamentals whose stock prices do not currently reflect their true worth. Buffett is a well-known example of a successful value investor. Growth investors, on the other hand, are interested in companies that have a strong potential for future earnings growth. Income investors value constant cash flow from assets such as dividend-paying stocks and bonds. This strategy appeals to people who require consistent returns from their portfolios over time. Number 4. Monitoring overconcentration in any one sector or stock. When constructing your investment portfolio, keep an eye out for overconcentration in any one sector or stock. Overconcentration happens when a large portion of your portfolio is invested in a single asset class or company, which can result in excessive risk. Diversification is essential for reducing the risk of overconcentration. Make sure your portfolio includes a variety of asset classes such as bonds, equities from diverse industries and overseas markets, as well as alternative assets such as real estate investment trusts. Number 3. Select investments. It's now time to put your goals, time horizon, and risk tolerance to work as you choose investments to help you get there. Stocks, also known as equities, are units of ownership in a publicly held company. You can buy shares in thousands of companies based in the U.S. and abroad. They tend to be a higher risk investment but also offer a greater chance of growing in value than bonds or cash alternatives. Bonds convert savers into lenders. Buying a bond allows you to lend money to a company, entity, or municipality. In exchange, the bond issuer pays you interest on your loan until you repay it in full. Bonds are typically less risky than stocks, but there are also higher risk bonds like junk bonds. If you can't afford to buy a single bond or share of stock, or simply want to spread out your risk between multiple stocks and bonds, you can invest using exchange-traded funds and mutual funds. These investments are stock portfolios. When you buy shares, you own a bit of everything in the basket. Your risk will vary depending on the type of fund. Number 2. Identifying investments with tax advantages. Identifying investments with tax advantages is a key component of establishing a successful investment portfolio. Holding tax-efficient investments in taxable accounts and less tax-efficient investments in tax-advantaged accounts, such as 401(k)s or IRAs, is what tax-efficient investing entails. If you want to invest in bonds, for example, municipal bonds can be a good choice because they are exempt from federal and occasionally state taxes. Tax advantage techniques can have a substantial impact on lifelong wealth creation and should be taken into account when making investment decisions. Retirement savings plans such as 401(k)s and 403(b) allow you to defer taxes and are among the most valuable tax breaks available to most investors. Number 1. Start with your goals and time horizon. The first step in creating an investment portfolio is to develop a list of your financial goals. Without an end goal, why you want to invest doesn't really matter, says Brian Robinson, a SharePoint certified financial advisor. Once you've identified your objectives, organize them by time horizon, which is simply how long you'll need to keep the investments until you need the money. Short-term goals are those for which you will need money within the next 12 months. That's a wrap on the video. I hope you liked it. If you did, let me know by giving it a thumbs up, and do not forget to subscribe. Thanks for watching. See you next time.